Corporate Reporting. ACCA P2 Corporate Reporting from frosty grey looking London. In fact, actually, London is looking lovely again today, a little bit hot. In fact, so hot you can probably see my face is looking a little bit red. That's partly the lights, actually, not quite as pink as that, but I certainly caught the sun this weekend. Welcome, P2 Corporate Reporting with me, Martin Jones. I'm just going to go mini-me to prove this. There I go, into the corner. There we go. There's that title we just discussed, and there's my email. Feel free to email me directly anytime that you wish. Last time that we were together, last week that we were together, we did basic groups and we followed that up by complex groups. Yes, indeed, we did. And this week we're going to do foreign currency and cash flow statements and current issues. It's a very natural breakpoint, actually, that we break for the 2 weeks between the two blocks of 4 lectures. So today is Tuesday. For those of you guys watching this as a recorded version, maybe on Saturday, today is actually Tuesday, and we'll be doing this fella over my shoulder on Thursday, so they come quite close together. So today is going to be foreign currency, and then next time we're together we do cash flow statements and current issues. And that's it, end of chapter 5. Current issues is a very weird subject, but it's the break point before we start what you might think of the classic financial reporting, which starts with session 5. So session 5 starts after a couple of weeks. Anyway, enough of that. Let's get down to work. So just behind me I have the class notes. I'm just going to highlight something to test that you can see me, you can hear me, you know what's going on. What is that year there that I am highlighting in violent pink? What's that fella there? Oh gosh, that was quick. Yes, the internet is clearly working very well. I'll do my usual hellos then. I've got Humayun and Ridwan, but not my usual crew of 50,000. Normally we have, well, I say normally, there's only been 2 sessions, but both sessions had 5 or 8 in them last week, which was fantastic. But it looks like it's just the 3 of us today. Humayun and Ridwan. That's okay. It's nice to have you here with me. You'll be able to make this seem more live, which will benefit those people seeing this dead online on Saturday and Sunday. Fantastic. So, as promised, we are going to be doing Forex. I'm just pausing for thought there because I'm trying to think how best to go to the chapter on Forex. I don't think there's any better way than just flicking through. So hold on to your horses. You might want to close your eyes now as we scatter through the notes. That's a bit slow for my liking. See if I can do it a bit quicker. Well, that really is making us drunk, isn't it? There we go. That worked quite well, though. Foreign currency translation is the subject matter. Let's go. I want that as a heading in my class notes. Well, that reminds me, actually. I'll do this straight away because I'm just thinking about this now, and I think I was thinking about it. I don't think I mentioned this to you last time that we were together. So I'm just going to zip off to MSN, as you can see, Bing, and I'm just going to put. What do I do here? Oh, yeah, Study International. Yeah, that's what I do. Just see if it's available as a, yeah, but there we go. I'm just going to go for this. You can see what I'm doing. Just logging in. My login is my email. Yeah, that looks good. I'm going to punch myself between the eyes. Poke myself in the eye. There we go, all courses. Let's find your course. So, live tuition September 2017. That's you guys. Punch myself in the eyes. Pow! Ow! I felt that. And this is the thing that I wanted to do. I wanted to see if this is working. Pretty sure it is. Did you know this, guys? Did you know this? When you go into a live session after it's become dead online. Obviously you can see the recording from the first hour there and the recording from the second hour there. That's fairly obvious, you knew that. But did you know that the administrators whack up the actual notes that I write? Did you know that? So these notes that I'm writing now on the screen, they're not available immediately after my session. My session finishes at 5 o'clock UK time, which is after the administration has gone home. But then they pick up, the administration pick up both the recordings and the class notes and turn these class notes into a PDF. So this is the class notes from the first session. I'm just going to close that now and show you the same thing by going back. This was session 1, right? I'll go back. Session 2 now. Let's go down to session 2. So once session 2 has been recorded, the recording obviously becomes available clearly. The live sessions, it's themselves, the 2 live sessions, the 2 1 hours. But also what becomes available is the tutor notes. There we go. It's good, isn't it? It's clever that, isn't it? So if you ever miss anything, you've got the PDF available anyway. You've got my handwritten notes anyway. Okay, I'm just going to close that and carry on. So these notes that I'm writing here over my shoulder, they're going to become available tomorrow morning as a PDF. Nice. Okay, off we go. Foreign currency translation. Ooh, it's a bit dodgy, this screen. Bit of a fighter. Oh, it really is a bit of a fighter. It's about right. Is it all good? Yeah. So off we go. Foreign currency. Foreign currency translation. Let's just have a look at these notes that I've got in front of me here or behind me. I'll look over there. That's the easiest. The easiest for you. Looks best for you. So I've got a little mini-me over there that I'm pointing at the moment. I'm actually pointing at my own notes. So let's have a little introduction. There's 2 different components of foreign currency to learn. One is dealing with foreign transactions and the other is dealing with foreign subsidiaries. And they're both very natural, to be frank with you. There's not really much to either of them. Foreign transactions, first of all. Oh, that looks very technical, doesn't it? But basically all you do is you just take the transaction and translate it at the rate the transaction took place. The spot rate is the fancy name for it. And then you retranslate at the year end. So you translate transactions at the point that they take place, and then you retranslate the monetary items at the year end, is what you do. And in order to reinforce that technical knowledge, I have 3 little questions here called furtive, feature, and actually a continuation of feature called feature continued. So there's 3 little questions for you to practice there. But what I want to do is I want to make up a couple of questions to reinforce the ideas that are just discussed just a moment ago. And the reason I want to make up a couple of examples is I want to leave these examples available for you as homework. Okay, so furtive and feature are little homework questions for you to have a go at. What I'm going to do is I'm going to make up a couple of exercises just to make sure you've got the idea. So, foreign transactions. All I want is an example 1 and an example 2. a company bought plant for 900 grobers, just some made-up currency, for 900 grobers on credit shortly before the year end. And that gives rise to two different exchange rates, one at delivery and the other at the year end. So $1 buys 5 grubers, what was it, grobers, and then $1 buys 3 grobers. Just a made-up currency, and we need this thing called an FX table, a forex table. Everyone calls it FX these days. I'm a bit old-fashioned. I still call it forex generally, but there you go. So this thing called the FX table measures the liability in its original currency. Then it uses a rate to measure the same transaction in the home currency, properly called the functional currency. So we're going to measure this transaction at delivery and measure the same liability at the year end. So what we owe the supplier at both measurement points is actually 900 grobers. That 900 doesn't change. But what changes is our feel towards this liability, because we don't work in grobers. We work in dollars. And when you divide by 5, you get, what do you get? You get 180, have I said that right? And when you divide by 3, you get 300. And that looks like a forex loss, doesn't it? Because it's minus 120. It does look like a forex loss, but forex is one of those subjects where you can actually find yourself tripped up by the sign unless you take a good look at what it is you're saying to yourself, to the marker. We have got it right, but I did check it before I said what I was saying. I did do this double check. We used to owe 180. We now owe a lot more. We owe a lot more. That's worse. That's a loss. So do be careful with the sign. It doesn't always work so that the sign gives you exactly what you're expecting. Just double check that your logic is following and you've got gains and losses the right way up. So that's it. What do you think about that? That's it. That's forex on transaction basis. Very natural, isn't it? It's perhaps so obvious you maybe don't even feel like you need another example. But just to reinforce this idea, let's do another example. So let's have the same as we had up there. A company bought stock. For 600 hops, whatever they are, I just made it up. and paid 1 month later. So we have a delivery rate and what is usually called a settlement rate, payment rate. So I just want to get, the opposite to the last one. So I'm just going to have a look at the numbers I used. What shall I use? 3 and 4. Does that work? 3 and 4? Is 4 going to 4? No, 4. It's not going to. 4 into 600 works, doesn't it? What is 4 into 600? How about 6 and 5? That's easier. That takes less brain power, doesn't it? So I'll go for 6 and 5. And which way up did I have? I had 5 and 3, so I want 5 and 6. Opposite way up will then give the opposite sign. Presumably, if I've got this logic right, I'm getting an FX gain at the end of my little calculation. So over to you. See if you can get ahead of me. See if you can get the FX gain. See if you can figure out what it is. I'll try and keep up with you. So what we felt like we originally owed at delivery was 120, but what we ended up paying was only 100, and that 100 completely extinguished the liability. And therefore, we got away with not paying 20. That's a good news. That is an FX gain. And yeah, good, excellent. That agrees with what Humayan has online, which is fantastic. I'm just going to have a sip of water to celebrate. And that's it, really. Well, that's it, really. But there is a little bit that I do need to add to this. And it's this. That gain will go through the profit and loss report. And therefore end up being accumulated in retained earnings. And that's a little bit trickier, isn't it? That little bit of accounting logic. Now, good afternoon, Greg. The balance sheet has got this bucket at the bottom called equity. And in amongst the equity is a reserve. And the reserve is basically the P&L reserve. And what it does is it accumulates all the profits that have been made since incorporation, since the entity is made since incorporation, might be 100 years worth of profits accumulated in this reserve. Now, P&L reserve is a perfectly reasonable name for it, but the more modern name for it is retained earnings, and it probably is a better name. And the way that things end up in retained earnings is by going through the P&L report. So this will have been, this speculating gain will have been slapped into the P&L report, and because the speculating gain ended up in the P&L report, it will have been accumulated in the P&L reserve. You got that idea? All right, let's move on then. So as we were finding out, oops, I'll go back again. There are two forms of Forex. There's Forex on foreign transactions and Forex on foreign subsidiaries. The Forex on foreign transactions says how to account for foreign transactions, and we found out how you account for foreign transactions. You translate the transactions and you retranslate the monetary items. How do you account for foreign subsidiaries? Well, what you do is you take those foreign subsidiary FS and you turn them into the home currency. And It's not really very difficult, to be frank with you. I'm just going to move that bottle of water because that's offending. Yeah, what you do is you take what the subsidiary does is the subsidiary produces a statement of financial position and a profit or loss, P&L and balance sheet, and what we do is we turn their P&L and balance sheet into our home currency. So have we got an example that's happening down here somewhere so I can just get a bit ahead of myself? There we go, peddler. So we're about to do question peddler. Can you see peddler looks very similar to pedal saddle handlebar, but first of all the associate's being knocked off, but the main difference that hopefully you can instantly see is that we've got a foreign currency, the Z, which is the zloty. So our home currency is the dollar, of course. So what we're going to do is going to take the P&L and translate the foreign P&L, translate it into dollars before we add across, and then we're going to do the same thing with the subsidiary balance sheet as well. We're going to take that and translate that. So off we go. Let's go for it. Let's just go for it in the traditional method. So the examiner is going to ask you for a P&L or a balance sheet. He's not going to ask you for P&L and balance sheet. At least that's what he says. So it won't be P&L and balance sheet, but it'll either be P&L or balance sheet. And the traditional method for answering P&L and balance sheet is you go net assets, goodwill, and you add across. If it is a balance sheet, you go net assets, goodwill, you add across on the balance sheet. And if it's a P&L, you go net assets, goodwill, and you add across on the P&L. So let's just do that. Let's just do the natural thing. So foreign subsidiaries. So foreign subsidiaries. And the question is peddler. And we're going to do the natural thing, which is the net assets at acquisition and at year end to give you the growth. So off we go. Just a standard question, no change from anything else we've done. So share capital 50, retained earnings 310 at the year end. Share capital froze at acquisition. When was the acquisition? We don't know. We don't care. It froze at that point. But what we don't have is the green information there. Let's go and get that by reading the question more properly now. So up to the top. The following are the summarised accounts of peddler and saddler for the year. There's a P&L. And there's a balance sheet. And then just below we have this. The shares in saddler are required on the first day of the year, as is almost always the case. Goodwill has suffered no impairment. It's the group's policy to value the NCI at fair value. The fair value of each of the non-controlling interest in S at acquisition was 325 as zlotys. Exchange rates were as follows. And as you can see, we've got acquisition rate, the average rate, and the year-end rate. Fine, great, sounds useful. Not quite sure what to use this information for, but not bothered about that at the moment. What I want to know is the green information. I want to know the P&L reserve at acquisition. Well, the acquisition was at the year-end, and we have a reserve movement. As usual, at the bottom of the P&L, there it is, at the bottom of the P&L. So for ourselves, for the parent, we made 170, we accumulated it on top of the 500, and that 600 went on to the balance sheet. There it is. So that's the logic of that flow. but a little bit more than we need at this stage, because all we need is this fella here, which is the retained profits at the year start at acquisition. 200. Where we go, whack it in. Nothing else going on in this question. So it's 250 and 360. And therefore the growth is 110. And we're not splitting that growth. Then into the goodwill. Interesting. So, what was the ownership split? Was it 80-20? I can't remember. Oh, it's on the balance sheet, isn't it? No wonder I can't remember. I haven't noticed it yet. 80%, there it is. So this is the ownership split. 80-20. So, 80-20. And of course, the purpose of doing the net assets working was so that we could slot the net assets in there. The purpose of working out the 250 was so that we could put it in there. So let's put it in there. Then we need the fair value of the NCI. That was given in the question. Where is it now? Right at the bottom there. Bottom of the narrative. There it is, 325 zlotys. 325 zlotys. Wait a second, hang on. 325 zlotys. I've been doing this question without paying any attention to the currency at all. Well, as you can tell by my continuing relaxed manner, that's perfectly okay. What I'm trying to do, of course, is work out the goodwill. That's what I'm trying to do. And what is the goodwill? Well, essentially, it's the customer loyalty down in zloty land. And what currency do you think you should measure the customer loyalty down in zloty land? Zlotys? Yep, that's what you should do. You should measure the goodwill initially, first of all, in its original currency. And that is exactly what you're doing. So the strange thing is, if you don't actually think about this too much, you end up in the right currency. You do end up in the right currency if you don't think about this too much. But there is a trap waiting for you in the yellow area here, which definitely does require you to have a think about the currencies, no doubt about it. You can't ignore it forever. And the reason becomes obvious when we look at the face of the balance sheet. Can you see this figure here? There's a lot of colour actually. I think I need to get rid of it. What colour should I use? I feel like using something funky. How about this? How about this orange? So that 260 there. That 260 there. Can you see that? It feels very natural to copy that as the cost of the investment in S, the fair value of the consideration. So 260. I'm thinking in red actually. It is wrong that this 260. If you just copy that like that, you can instantly, if you're sharp, you can instantly see that doesn't feel right. Because 80% is worth less than 20%. 20% is worth more than 80%. No, that doesn't look right. What mistake have I made there? The mistake I've made there is I've continued to ignore the currencies. Clearly, this is the first bit of information that we have in the wrong currency. Actually, that 260 doesn't represent what P originally spent, because P will have spent zlotys to buy these shares down in zloty land. So what we need is the original number of shares the original number of zlotys that were spent to buy the 80%. Now, I haven't done anything with the currencies down there. I've kind of ignored them, haven't I? And I think I'll pick up all three of them now. You've probably guessed The reason we need the acquisition rate is to work out the goodwill at acquisition. You've probably guessed the reason we need the average rate over the year is to help us translate the P&L, the sales, over the year. And the reason we need the year-end rate is to translate the balance sheet at the year-end, to translate the assets at the year-end. So that's the purpose of those three rates. Of course, we're doing the goodwill at acquisition, so we need the 5 just now. So what we're going to do is we're going to re-engineer how much must have been spent down in Zlotyland. Now what the dollar accountant did was take the zloty consideration and divide by 5. What our accountant did was take the original consideration and divide by 5 and got 260. Now in real life, if you wanted to know how much was really spent, which is 1.3 million, it's 1,300. If you wanted to know how much was really spent, you'd look at the contract, and you wouldn't do what I'm doing here. And this is a little bit naff. It's one of those daft things that happens in examinations because exams are exams. But you know, if you really wanted to know how much was spent in, you know, buying the 80%, you'd look at the contract to buy the 80%. That's what you'd do, wouldn't you? Obviously, that's what you do in real life. But we're not in real life. So what we're going to do is we're going to re-engineer how much it must have been spent. Now, if the accountant divided by 5 and got 260, to get back to the original consideration, we multiply by 5. We take 260 and we multiply by 5 and we get 1,300. And that looks more like it. More like what? Well, you know, this thing here. 80%, 1,300, 20%, 325. That looks roughly right now, doesn't it? And sure enough, it is. So adding down, we get 1,375. So the goodwill at acquisition was 1,375, and at the year end, it'll be 1,375, 1,375, 1,375. And next year it'll be 1,375, the year after that it'll be 1,375. So the 1,375, the underlying 1,375, flat lines, it doesn't change. But our measurement of it, in our currency, that does change from measurement point to measurement point. The underlying goodwill is flatlining, however. Fresh new brand new page. Do I need fresh? Let's just stick it down here. Fresh new brand new page, as symbolized by ruling off. Now the goodwill is 1,375. 1,375 zlotys. But what we're doing now on the group position statement is making a statement. And the people that we're talking to are our group shareholders. And our group shareholders think in dollars. So even though the underlying goodwill is 1,375, we're going to translate that information for their benefit so they can see how that feels in their currency, because the people that we're talking to think in dollars. So the position of the position statement, that's why I highlighted position, the position of the position statement, the position in time is at the year end. So the rate that we need is 7. And it's just the first of many times that we use the 7. So you just divide by 7, divide by 7, divide by 7, divide by 7, divide by 7. Each time you do that, you're picking up half a mark. And that's why this subject is so nice, you know, because you get this repetition, repetition, repetition. Whoops. 1,375 divided by 7 gives 196 roughly. And then we've got net assets. Now this is a compressed balance sheet. So we don't get the repetition you do in the real exam. We've only got these two numbers here, and only the 360 is in zlotys. But that net assets in the real exam would be split between, you know, PPE, inventory, receivables, bank, etc., etc. And every time you divide by 7, you get a mark, so it's great. So 510, 360. So 360 divided by 7 plus 510 is 562, just rounding up, giving us 196 plus, why am I using my calculator for this? 758. In the exam you add across but not down. In the exam you add across but not down. In the classroom here we're just trying to balance the balance sheet. Sorry, what? I just woke up to find OCE sitting there. I wonder what's going on there. Well, hang on there for a second. Let's keep rolling and I'll show you some stuff. So share capital. We just copy the parent share capital. 100. And then I think I'll do NCI next. Different ways of doing NCI, but probably the easiest is this. Oh, sorry guys. What did I do? Usual thing here. You'll remember me highlighting this in hoops. Usually I use red, so I'll do that as ever. It's 325 plus 20% of 110. 325 plus 20% of 110. Which gives 22, and therefore 347. But this is in dinars. And what I want is the NCI at the year end. And because I want the NCI at the year end, I want the dollar version of this. And in order to get from the dinars to the dollars at the year end, I have to use the rate at the year end. I use 7 one more time. And I get 50 basically. Let's just check I've got the number right. Because then I want to bamboozle you with some techie stuff. Up we go. So here's the techie stuff I wanted to do. It's a bit of language. The internet seems to be quite quick at the moment, so I'll go for it. I want to do a bit of Q&A with you guys. What is that green blob called? What's the name of that green blob? What's it called? It's called equity. That green blob is called equity. That orange blob is called NCI. Oh, good, yes. Good, there seemed to be a bit of a delay there, but you got there in the end, and maybe that was the internet. That orange blob is NCI. What's this yellow blob called? That orange blob is called NCI. What's that yellow blob called? The orange? It can be, yeah. Not usually. NCI and not NCI. The yellow part is non-controlling interest. It's called controlling interest. What is the sum of controlling interest and non-controlling interest called? What is the sum of controlling interest and non-controlling interest called? Seems to be a bit slow. The sum of controlling interest and non-controlling interest is called equity. What's equity made up of? It's made up of controlling interest and non-controlling interest. So we, the controlling interest, have control of the entire balance sheet, but we don't own it all, and the bit that we don't own is the non-controlling interest, and the bit that we do own is our controlling interest. But the reason I did that was to get you into this language, or towards this language. Do you know what the green thing's called? Just be interested. Give you a second. Do you know what the green thing's called? Those two together. You've almost certainly heard the phrase. That's called reserves. So we're now going to do the reserves movement. The reserves working. Yeah, good. And they both work exactly the same actually, but we'll focus on the one we know, which is retained earnings. So the retained earnings in the parent is a figure of 670. Retained earnings in the parent is a figure of 670, as you can see. And the parent made money by its own work, also by buying a sub that made money. And it owns 80% of growth of, was it 110? There it is, 110. Divide that by 7. Oh yeah, of course, it's foreign stuff again. Any foreign stuff, you need to get it into the home currency and the reserves at the year end, on the balance sheet at the year end. 0.8 times 110 divided by 7 equals 13 approximately. Wait a minute, I've got to round that one down. I rounded the other one up. Doesn't matter in the exam, I'm just trying to make this balance. And then we have the FX. Oh yeah. The FX. What FX? Oh yeah. There's a foreign subsidiary, and this foreign subsidiary hit the balance sheet at the year start, and now it's being remeasured at the year end. This subsidiary, do you know what? This subsidiary is growing. You can see from the growth. But in our terms, it could actually be growing more, or indeed shrinking because of the movement in the currency. You know, there is a Forex bit there. I better work that out. So let's go and work out the Forex fella. So we need a separate working for the FX. And what you do to get the FX for the reserves here is you take the golden fella, the cost of the investment, the fair value of the consideration. You take this 1300 and you measure what it's worth now and what it was worth when you bought it. What it was worth when you bought it and what it's worth now. So what's this fella worth at the year end? And what it was worth at acquisition. And we need this figure in its original currency, which is the zloty, almost forgot, 1300. And then we need to use a rate to find out what it's worth now in dollars. So just make a note of what this fella is. This fella is the original fair value of consideration. And we're going to measure it using the rate at the year end of 7 and measure it again using the acquisition rate of 5. Oh, by the way, I'll remind you of those rates. So those rates, I didn't make them up. They did come from this table down here. There they are. 5 and 7, 7 and 5. We get a difference between those. So 1300 divided by 7 equals 186, roughly. And 1300 divided by 5 equals 260, of course. We should know that because, of course, the 260 was on the balance sheet at acquisition. Then we get a difference, which is 1474. And the asset has shrunk in value. This was an asset, of course. It's equity ownership in shares, isn't it? And the equity has shrunk in difference. That's right, very good. And a shrunk in difference, and therefore it's that minus 74 really does mean an FX loss. And that FX loss goes through the OCI into the OCE. Huh? What? Huh? And you can see that there's something going on here in FX, which is not really the numbers itself, not really the FX logic itself. It's to do with these references to the OCI and the OCE and the P&L report and the P&L reserve. There is definitely something going on in the area of performance reporting. But leaving that for a moment and coming back to this, when a gain goes through the OCI, the other components, other comprehensive income, even I'm getting the names mixed up, the other comprehensive income, when a gain goes through the other comprehensive income, it ends up being accumulated on the balance sheet in other components of equity. That's a heck of a mouthful, isn't it? And works really well with the abbreviations. When stuff goes through the OCI, it gets accumulated in the OCE. Now, of course, I haven't taught you this, and so there's no reason that you should know it, but you probably do. Revaluation gains go through the OCI, and because revaluation gains go through the OCI, they end up getting accumulated in the OCE. That's how it works. Now, this is another one of those. Forex gains on foreign subsidiaries go through the OCI and end up being accumulated in the OCE. So this balance here is 74 is going to go here in the OCE. Minus 74. It's going to go here. Wait a second. What's the opening balance on OCA? What's the parent balance on OCA? Huh? Let's go and have a look. The parent doesn't seem to have an OCA. What's the parent balance on OCA? The parent doesn't seem to have an OCA. Ah, if it doesn't have an OCA, then its opening balance must be 0. And what's happened is we've opened up a reserve, and the first thing that's been accumulated in reserve is a loss. So we end up carrying forward a negative reserve, which is not particularly unusual. It doesn't happen that often in the exam, but actually in real life it's pretty common. Now, because that is quite tricky, let's do more than just state that that 0 is 0. Let's revisit it again. It's perhaps not surprising. It isn't surprising that that 0 is 0. This is the first year of our first foreign subsidiary. Of course, the 0 is 0. It's the and then now the balance going forward will be minus 74, would be carried forward next year. So that's the first balance on our first year. I didn't say that quite right. That 0 was the opening balance on the day before we had any foreign subsidiaries. So there's nothing going on, so there's nothing in there. I think maybe I'm over-explaining it now. So I'll just remove that orange and then we'll add down and we'll see what happens. So 682 and minus 74. So it's 8. How do I do this? I probably suppose I just copy that there, really, don't I? So that's 74. 58. Yeah, it is, isn't it? 758. And by the miracle of group accounting, the balance sheet balances. What's the chances of that happening in the examination? Absolute 0. And there you go. And it does feel like the question's finished, but of course we haven't done the P&L report yet. Now, oh gosh, I have very mixed feelings about the P&L report, but there is a very strong culture of using columns on the P&L report. So what the heck, should we just do it? Because that's the culture. So we go parent, sub, rate, sub, adjustment, group. Hang on a second, hang on. I thought there was just one sub. Well, the culture is to do the sub first of all in zlotys, then use the rate to get it into dollars. Everything else is in dollars already. Oh, sorry. Including this fella here, which is the adjustments. Do you remember me talking about that on the first session, The adjustment column is utilised to accommodate what's called intercompany transfers, when the left hand sells to the right hand or the right hand sells to the left hand. When there are intercompany sales, intra-group sales, they've got different names, but you know, when the parent's selling to the sub or the sub is selling to the parents, we pull out these fake sales using the adjustment column, and it is utilised in all real exam questions. But this is not quite real exam question standard yet, so we don't have any of that going on, but we do have plenty of foreignness, and off we go. So 500 plus 400. And that 400 is going to be divided by the rate over the year. Should have highlighted that earlier, really, shouldn't I? So that's this thing here. Of course, the sales are over the year, so we use the rate over the year to turn them into dollars. So we divide by 6. Must be a good way of doing this. This 6. How do I do this? I have no idea. 6 into 400. There must be a clever way of doing this. 66 multiplied by 4. Doesn't seem a very easy way of doing this. What number is it? No, it can't be 150. That must be something else. Wait for it. 6. Why is my brain not working? It is 66. There you go. Just getting tired. 66, isn't it? 67. 400 divided by 6 is indeed 67. Don't know why it took me so long. 567. So we add across by picking up these babies here. Like that. And what's next? Operating costs, I suppose. Oops. 200, 210. Oh, there must be a good way of doing that. 6 into 210. I know how to do that. That's 35. Half of 70. 235. Yep. Yep. And we abbreviate all the profits because there are no marks for any of the profits. OP. What is OP? Was the associate? Did I make you jump? I hope I did. Remember, you go slightly insane when you get to the operating profit because there goes the associate. Of course, there is no associate in this question. I've stripped that out, haven't I? But in your exam question, there always is. And it's worth 2 marks, the easiest 2 marks in the whole exam. All you do is just take the part and multiply by the appropriate percentage. Unbelievably easy, but equally easy to forget. So every time you go to the operating profit, you want to go slightly insane. You go, where's the associate? Where is it? Well, we don't have an associate, so we just carry on. Interest, 50 and 20. Ugh. By 6 gives 18. 18. Oh, what am I saying? 18 divided by 6 gives 3. That's what I mean. Therefore 53. Sorry if I confused you there. Uh, 80 and 60. Oh, there we go at last. So 90. Well, hello. Who sits between Pat and Pam? Let me remind myself of something, actually. It was rather cute that I went off to the live sessions and showed you the notes, because there's different ways of presenting this thing I'm about to do here. Oh, I'm going to punch myself in the eye. Puncha! It's rather cute that I've got this here. So I'm going to actually go and have a look at my notes and see how I did pedal, saddle, handlebar. Because I think I remember how I did it, but I would just want to double check. Pat and Pam. There's a couple of different ways of doing Pat and Pam, you see. Open it up. There we go. I have a feeling I did formal Pat and Pam. Ooh, I did, yes. A formal German flag. Lovely. So I'll do that exactly like that now. Here we go. So, well, hello. Who sits between Pat and Pam? So who sits between Pat and Pam? Who sits between Pam and Pat? Now, there's no marks for the Pam and there's no marks for the Pat, but there is a mark for the non-controlling interest. And that's why I do write NCI in full, because there's a mark for it. And that's why I don't write Pam and Pat in full, because there are no marks for either of those two. Doesn't matter what I put there, there's no marks for it anyway. But just to remind you, Pat is profit after tax. I'm sure you knew that. Pam is profit attributable to members, and I think I'll remind you of the logic of that just by using the German flag. I won't use any numbers this time. So what am I doing here? I'm working out the NCI. What you do is you get pink Pat. I think I had pink Pat last week. So I'll have pink Pat again this week. You go up to the top, 67 minus doodly doodly doodly. So can I do that in my head? So that's 48 from 67 is basically 19. Yep, 19. So it's 19. And then you take that 19 and you multiply by 20%, and that gives you what am I doing there? What am I doing now? I can do that in my head. 3.8. Quicker in my head. 3.8, or if you prefer 4. And just to remind, there's no marks for any of these numbers here that I'm scratching out. It does seem a little bit odd to try and explain these without the use of numbers, but it is appropriate. To be a naughty boy if I actually work these out again, because that kind of implies there's value to it. I don't want to do that because there is no value to either the black or the yellow. There is value to the orange. So what we're saying to the shareholders, if I can just hold up my hands, is what I'm saying to my shareholders is you made a profit of yellow, of which 3.8 belongs to the other guys and the rest is yours. You made a profit of which black is yours, 3.8 belongs to the orange, belongs to the other dudes, and orange plus black gives you yellow. That's the total profit that the company made. The company made profits of yellow under your control. And although you controlled all of the yellow, some of it, the orange, belonged to some other dudes. The black was yours. That's what you're saying to the shareholders in that Pat and Pam section at the bottom there. And that's it. What more can I say? Wait a second, hang on. Surely you can say a bit more, Martin, because there's been an FX gain. I remember it. It was minus 74. It was minus 74. Where is it? Where has it gone? Well, it's a good question. Well, it's just a stroke of luck the way that worked out. But rolling this on a bit further down the page. The performance report just continues on down the page. And the proper name for the performance report is the Splocky. And the reason it's called the Splocky is it's the SPLA plus the OCCI, the statement of profit or loss and other comprehensive income. So now we need the group OCI. And the law says something very, very odd about FX, which you can see me looking down at my screen there, can't you? Which feels natural to talk to you, talk about now, but it really is time for me to give you that break at the hour point. So I won't give you the logic of this until after the break, but I'll give you the numbers. What you do is you just pick up the FX if you like, sub FX, and you whack it in here. And actually it belongs to the parent as well. Sorry guys, it belongs to the parent as well. And I'll tell you the truth, although you won't get any of this detail this week, you'll get it all next time you see me in 3 weeks' time. There are in fact 5 items that go through the OCI, and they are and foreign subsidiary FX. In the exam you wouldn't actually have all 5 going through, there's no chance of that, but you wouldn't have 1 either, there's no chance of that. Usually 2 or 3 items going through the OCI. We're next door to Sainsbury's, aren't we? Let's see, I can't remember Sainsbury's P&L, but let's see if I can guess. Or maybe I'll have a look at it at the break and see what they have going through. That'd be interesting. Maybe none, maybe 3. So even Sainsbury's, which is a real company across the road, is very, very unlikely to have all 5 going through. So there won't be just that happening in your exam. There'll be that plus other stuff. You probably know. One of the other things is PPE revaluation. Now Sainsbury's, I'm pretty sure, don't have PPE revaluation, but you probably will. So PPE revaluation goes through, sub FX also goes through as well. And that's the end of that. I think if I say any more, I'll get into the theory of this and I'll start to open up a hole that I shouldn't open up until I can do the theory with you after a break. So let's call a close on that. I will close up this recording and I will see you in 5 minutes and we will carry on together and I'll talk to you about the theory of what crazy stuff we have on the screen. Just there. Excuse me. See you in a sec.